Focus. Ideate. Innovate. Enable.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Well, it is true when they say an investment in knowledge will pay the best interest. Now, following the same principle, we are here to help. Welcome to the Mutual Fund Day Family Financial Plan series here on CNBC TV 18, where we, along with the experts, help you carve the best path for reaching your financial goals. Now, in each episode, we feature a different investor whose money management has improved thanks to smart financial planning. This episode is no different. Our latest investors are Yashodhara and Ashish Raj from Delhi, and we have with us their financial advisor, Gurmeet Chadda. So, let's begin by taking a look at their financial planning journey so far.
On this episode of Mutual Fund Day Family Financial Plan series, we are going to look at the financial planning journey of Ashish and Yashodhara Raj. The couple have 2 children and are based in Noida. Ashish, a forestry management graduate, is employed with an American consultancy firm in Noida itself, while Yashodhara freelances as a corporate trainer. Ashish has been a regular investor ever since he started his career. However, Yashodhara started her investments into mutual funds much recently.
I never thought of investing into any unit-linked policies or SIPs or anything. But recently in 2017, I was just going through a blog. So then I thought, let me get into it and did a little bit of study about what exactly investment is all about and how much returns I'll be getting. So right now I have invested into few things. Now around 20% of my savings I make sure to invest in that.
The investment journey started when I started working in 1999, and it took the usual route. Started investing for tax planning, so invested in some NSCs and then PPF, took some LIC policies, then moved on to unit-linked policies, which in retrospect did not turn out to be a good decision. And it's only since last 3 years that I have started investing in equity and mutual fund SIPs.
Ashish and Yashodhara have been realistic in their approach to achieving their goals. The family aims to create a sizable corpus for the child's education. Apart from their own retirement planning, the couple also plans to start their own business venture post-retirement.
Yeah, my short term, basically I'm focusing right now on my children's education. So I need to concentrate more on that part.
When they go in for higher studies, you need a substantial amount of money. And then the longer term goals are their marriage and then our post-retirement fund that we would need to kind of carry on our life peacefully and happily.
For long term, my retirement plans, our retirement plans rather I'll say, and children's marriage and of course their education also, because those things will be more into highlight. And in fact I'm planning for my own venture also, so those things post-retirement. So before retirement you are getting into venture mode is a very different thing, and post-retirement you have to think about taking risk and challenges. So yeah, I'm keeping it in mind.
Alright, now that we have a broad understanding of Yashodhara and Ashish's investment journey so far, it's time to take a short break. But when we return, we'll analyze their balance sheet with the help of Gurmeet Chadda, an independent financial planner. He'll provide to us the expert insight on smart money management. Keep watching CNBC TV 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back. You're watching the Mutual Fund Day Family Financial Plan series. Now, the previous segment highlighted our featured investor Yashodhara Raj's approach to financial security. In this segment, we learn more about her and her husband's investments and goals. And we have with us Gurmeet Chadda, an independent financial planner who will help us analyze their balance sheet. Gurmeet, Yashodhara, Ashish, thank you so much for joining us on the show. Let's start things off by taking a quick look at how the finances at home are managed. So Ashish, between you and Yashodhara, the household income per year comes to around 50 to 55 lakhs. Now, deducting expenses, how much do you manage to save, and what's the income distribution between you and Yashodhara?
The income distribution would be, say, around 60-40.
Okay.
And the household expenses work out to be around, say, 50-55%.
Okay. Now,
of our income, yeah.
All right. So that's how the spread works between you and Yashodhara. Now, you started investing. Both of you started investing, I think, in 1999. So tell us about the background on how your journey into financial planning started, Yashodhara.
Gautam, I started recently in 2017. A long journey. Ashish used to do the investments and all, but I had a trauma or block somehow got from my parents that no, share is something, don't put it in market, even any type of either anything investing, no. So I used to keep all my amount in my account, bank account. So suddenly one day I just saw a blog and I don't know what clicked in my mind that keeping lakhs of rupees in my account, not investing anywhere, not putting anywhere is just okay. Rather maximum I used to do FDs or simply just putting it in bank, that's it. So yeah, at last I felt that yes, now it's time, the time is there.
To move into a much more richer portfolio.
Yes, so I just took help of the financial advisor and that helped me out.
All right, so let's get more details on that, Ashish, before I speak to Gurmeet about the performance of your portfolio. You started with FDs. What other instruments did you move on to?
So
in
to
your
begin
journey?
with, 99 was when I started working, and that was the initial trigger was tax saving. So whatever little tax was there, you can save by investing in the national, with the post office. You have those NSCs and those kind of things. So that was how I started with. Then one takes a LIC policy. So I have still 2 LIC policies going on from 99-2000. And then moving on, I kind of moved on to taking a few ULIPs, which in retrospect would not be, I wouldn't say it was a very wise decision, but then again, at that time I was not very financially savvy. Moving on from there, I entered the mutual fund quite late, just kind of 3 years back, and that's when I started having those SIPs.
So what's your split in terms of portfolio now? If you could give us a sort of a ratio in terms of percentages to mutual funds or directly in equities or property.
See, equity would be 30% of the total amount that I put in the market. So this
is including direct investment in equities and mutual funds.
So 30% of the amount that I put in the market through mutual fund or ULIP or equity.
All right. So we've heard about the portfolio of the couple. Now, let's get an analysis of their portfolio and also look at the fact that one of them has a fixed income and one of them has a fluctuating income. Now, in such an instance, how can financial planning be harmonized with me?
Yeah, so I think Ashish, typically summed it up. What happens with most Indian investors, you start your investment roadmap journey with tax planning, and tax planning being synonymous with investment. So I think Ashish is no different. What I'm very happy is the fact that they have some idea of the asset allocation. So asset allocation is the foundation on which a financial plan is built, and I'm very happy to see that despite being late movers into financial instruments like equity and mutual fund, they still have 30% weightage to equity. Coming to how should be a plan for a dual income household where one has a fixed income and one has a variable income. I think we are seeing a lot of couples now having this pattern where so there is an interest in being an entrepreneur and startup and people move doing on their own. So what we suggest for them is that work out a common denominator of your household income. Since their ratio is 60-40, and let's say if the household income is about 50 to 55 lakhs, about 30-40 lakhs they will have fair degree of prediction in terms of that being the common bare minimum denominator of annual income. And after deducting the expenses, now this 55% would be out of 40 and not the overall income. The remaining amount can then be structured into short term, medium term and long term goals. And whenever there is any lump sum payment which they get because of the job nature of the work Yashodhara does, that can be parked into a saving account or a liquid fund, and then can gradually be moved into the 3 buckets, which are your short-term, medium-term and long-term goals.
All right.
So, and I think one point I wanted to make, that's never too late to start.
All right. So let's speak about those short-term goals part. Now, should the progression for dual income families be that you save money, park those savings in a debt-linked mutual funds, build your your asset base, be comfortable with liquidity, then focus on your short-term investments by looking at, say, hybrid or balanced funds? Is that how an ideal progression should be for dual income families?
Yeah, I think you're right. What a very important factor we need to understand is, we need to understand real return. We need to address this demon of inflation, which we as a nation face. We have a very high level of inflation, and the aspiring middle class, the inflation levels are much higher, as what reflected by a CPI or a WPI on the news channel, because we are an aspirational middle class. Our expenses go up at a much higher trajectory than a regular median population. So you have to be at least closer to inflation, if not beat inflation, because in short term you don't want to take a lot of risk. Second, the liquidity has to be of paramount importance. The money should be accessible, at those time goals as and when they arrive. Third is the tax efficiency. Wherever possible, can I add an element of tax efficiency and can save that extra 50-100 basis points to build on that.
All right. Now let's focus on the fact that you have substantial weightage towards property with a property in not a tier 1 city.
Right.
So what's the rental yield you're looking at there, and what's the long-term plan with regards to the property that you have?
Yeah, see, the property we bought in Lucknow was when I was posted there. I had a job there, so we started living in it, and then we moved out of Lucknow, came to Delhi, and that's when we rented it out.
So Gurmeet, coming to you, what would be your advice as a financial planner to investors who have a high exposure to property relative to their portfolio? Where do they start?
Yeah.
In terms of making more money from their portfolio, because property, again, static. While there is always that appeal of a rental income,
Yeah.
you still have far more flexibility with funds. So what would your advice be here?
Yeah, I think the important point here to note is, as Ashish rightly started off, is by calculating the rental yield. So if the rental yield on the property is around, let's say 4-5%, so which is a good rental yield, which is also closer to the return you make on fixed income products on a post-tax basis, and add to it some appreciation over a long term. Obviously right now real estate is not in great shape, but since it's their old property, you want to hold it for a longer period of time. So as long as the rental yield is closer to that range, we advise clients that since it's rental yielding and add some appreciation, you are again beating inflation, and it's creating to wealth creation. But you should not have multiple properties. Real estate should be for consumption.
Okay.
Real estate as an investment, this is not a great time. And so if you are stuck and you have higher exposure to real estate, one should try and figure out what is the cost, opportunity cost, because a lot of the real estate is leveraged. You are taking EMIs, and that's an interest cost going, and if interest cost is higher than the rental yield. So one needs to take account, and may not be in a rush to sell it because the markets may not be very, very supportive right now, but look at gradually trying to trim down the portfolio.
All right. On that note, we'll take a short break, but we'll be back to discuss much more on financial planning with Yashodhara and Ashish, and of course Gurmeet with his insights on financial planning. So stay tuned to the Mutual Fund Day Family Financial Plan series.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back to the Mutual Fund Day Family Financial Plan series, the final leg of the discussion. Lots more insights on money management coming up. So let's dive right in. Let's talk about the short-term goals here. Meeting children's education fund targets. That's the key element for any parent's financial planning. So what's the education fund target that you have set for both of your children?
Now, for me, right now, I'm planning 1 crore for another 10 years. I'm in the return, and since the kids will be growing, so for their education, I need to balance it out. So at least 1 crore after 10 years.
Okay, so You have a target there, Gurmeet, 1 crore after 10 years. It's quite an ask. So, looking at their portfolio, what sort of tweaks and adjustments are necessary? And in terms of advice, what would you give them to meet that education fund target comfortably?
I think the portfolio is in place as far as the education goals are concerned. They are doing an SIP of about 45,000 rupees a month, which if it compounds at around 12%, which is what the nominal growth in the economy is, we should be closer to 1 CR. What I would also like to also do is to add a little more texture of hybrid funds, and because the goal, though is 10 years away, we could also have some intermittent rebalancing to do as we are closer to the goal.
So what's the mix of funds, say 3 or 4 funds via SIPs? That's the
so
route
they have about
to
close to 5 funds, which are largely equity mutual funds. We would may like to add a balance fund also in due course of time, but for now they are on track as far as, and the good part is they are realistic about the goal. It's not, sometimes you tend to have a higher goal but you are putting too less an amount, being over optimistic. So I think that credit goes to.
All right, and let's shift focus to your long term goals now. That includes children's marriage, buying another house, starting another venture, and retirement planning. So how have you structured your investments in terms of meeting all these targets?
See, as I shared earlier, I kind of started late investing in mutual funds, so we plan to gradually increase that and maybe double that over the next year or so, and also keep investing in equities. And I am a very optimistic person, so the kind of funds I started with were all small and mid cap, where you have a high risk and high return ratio over there. So that's what the plan is. And we also plan to buy another house. So that's one thing which is in our plans right now. So yes, so that's what we have thought of.
Okay, so lots of
increasing the mutual fund,
increasing the exposure to mutual funds. That's your key strategy here. Now, how should they tweak that strategy? Because the ask is quite substantial. Because children's marriage, substantial cost; buying another house, substantial cost; retirement planning, and starting a venture post-retirement. So these are quite a lot of asks. So how should they tweak their portfolio to meet all these targets?
So one advice to them is, and I think they are also working on it, is they are trying to liquidate an existing property which is not yielding enough income and appreciation both. So that pot of money which that will generate can go towards these the long-term funds, long-term bucket which they have. The other thing which Ashish rightly mentioned, he plans to double the SIP amount over next 3 years. I think that's a very, very important point to be noted, that SIP is not stationary. While it is an equal monthly investment, you need to keep stepping it up basis the annual increase of your household income. And typically we do the other way, we spend and whatever little left is saved. I think, as Mr. Buffett says, first decide what is to be saved, and then has to be invested. So I think they are on track. Their savings percentage is around 25-30%, which for financial advisors is pretty impressive.
Now the other targets are pretty conventional, but looking at the fact that they want to start a venture post retirement, how do you think they should plan their investments? Because there is going to be ups and downs in any venture. Plus you need a regular monthly income at home post retirement. So how do you think that should be managed?
I think they have a bit of a balance in terms of the texture of the portfolio. Since Ashish said he's a little aggressive on the small and mid cap side, and he understands that over a long period of time, which is 10-15 years, it's very important to define the long period first. And I think one thing they've done is they've defined the long period pretty well, which is more than 10 years, 15 years. So the asset allocation is more towards equity funds, and within that he's a little overweight on mid caps, and he does a lot of research on his own. And the level of involvement when you do this kind of investing also has to be high. You can't just passively keep putting money in aggressive strategy. My advice to them would be that gradually they have to set, even in long term, 2-3 buckets. One is the retirement bucket, and one is the aspirational entrepreneurial venture which they intend to take, and then divide that into 2. So it's an aggressive ask right now, but if they can liquidate a part of their existing traditional assets and real estate, and then gradually move into it, I think the goal is achieved.
All right, before we wrap up, what are the key lessons, Yashodhara, that you've learned in your investment journey so far?
Yeah, so it's not that long journey, I'll say, of investment, but yeah, certainly now I have to be more organized. I have to look for my not only retirement plans, but yeah, certainly my overall how I'm going to make a structural plan for my own self. Earlier I used to keep everything deposited, like recently I'm going to sell my some ancestral property. So how I'm going to invest that money, where I'm going to put in, which all cadre I'm going to allocate that money, I'll be taking care.
All right, and Ashish, what's your summary statement in
Yes,
terms of
so
lessons
if I talk
learned?
about my exposure to the market, it has been 3 years now, and I've dabbled with equity, mutual funds and some F&O as well.
How have you found the journey?
So I found the least of my effort went into the mutual fund SIP. Equity, it's very difficult to directly, when you're investing, it's very difficult to time the market. It's very difficult to know when you're going to withdraw.
All right. On that note, we'll conclude this episode of the Mutual Fund Day Family Financial Plan series. I'd like to thank Yashodhara and Ashish and of course Gurmeet for coming here, sharing with us your financial planning journey and of course sharing with us insights on money management. But stay tuned to CNBC TV 18 and of course the Mutual Fund Day Family Financial Plan series will be back with another case study of financial planning. Stay tuned.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus. Ideate. Innovate. Enable.